I'm Matt Bouchard in San Francisco for NAREIT's REIT World, our 2018 annual conference. Joining me today is Dave Bragg, Managing Director of Strategic Research with Green Street Advisors. Dave, thanks so much for joining us.
Thank you for having me.
Now, Green Street closely studies both the public and private real estate markets. Can you describe the relationship between the two markets in terms of valuation?
Absolutely. It's fascinating that over the long term, the relationship has been very consistent. When you look back over the past 30 years at the core sectors, which are apartments, office, industrial, and retail, they've traded in line with the underlying value of their assets for that period of time, on average. And that makes sense because REITs are a collection of properties and management teams tend to add as much value as they subtract over time. However, that long-term average can be a little bit misleading because about half the time REITs trade at greater than a 10% NAV premium or 10% NAV discount.
Now, why are those variances so large?
The variances can be very large, and one reason for that is that public market pricing often leads private market pricing. We saw that, for example, on the upside from 02 through 06. The REIT market was trading at big premiums to NAVs, and subsequently private market pricing caught up. The same thing happened earlier this cycle at the beginning of this decade. And the phenomenon works in reverse as well. In 2007, REITs were trading at large discounts to NAV, and that ultimately foreshadowed the decline in private market values. However, at times the REIT market can send a false signal, and that's what has happened in recent years as the core sectors have traded on average at pretty significant persistent discounts to NAV, and that has suggested a decline in private market pricing that has not materialized. Therefore, there are other reasons for the disconnect between public and private market values, and one of them is the fact that capital flows can be very different into the two markets. Public market investors don't necessarily get to allocate capital to the private market, and many private market investors don't necessarily view the REIT market as an optimal place in which to get their real estate allocations. So it's surprising to us, but after all these years, these two markets remain pretty balkanized. Therefore, it's really important to understand the diverging fund flows that can materialize between the two sectors, or between the public and private market. And that's what we've been focused on lately. So we recently developed a new product. It's called the FlowTracker. It looks at public and private market fund flows and ownership.
And speaking of Green Street's new FlowTracker research, what are some of the key findings?
Well, researching this was pretty complicated. There's a lot of data out there focused on fund flows. And it took us a good amount of time and effort to distill it down, to evaluate it, and to make it digestible. Although there's a lot of data, there's not much insight and analysis, and that's what we were focused on. So we took all of the information that we had and we segmented owners of REITs into 4 groups: dedicated active, dedicated passive, generalist active, and generalist passive. And that allows us to paint a pretty clear picture of the ownership structure. And within those 4 groups, the biggest and most interesting change over the last several years has been the continued decline in market share of dedicated active investors. They've declined from 50% market share 7 years ago to only about 1/3 today. And that has weighed on the performance of some high-quality REITs that those dedicated active investors tend to own in overweight positions. And in the past couple years, those outflows have been concentrated in Japanese mutual funds focused on U.S. REITs. It's a very unusual phenomenon that materialized in Japan at the beginning of this decade. A confluence of factors, including favorable currency tailwinds, high dividend yields, caused Japanese ownership of U.S. REITs to climb to as high as 7%. That peaked a couple years ago, and the currency tailwind has not been as favorable lately. The Japanese regulator stepped in and issued a warning over these unsustainable high dividend yields, and we've started to see some declines in AUM and also in the dividend yields from the Japanese funds. That has accounted for just about all of the outflows from REIT dedicated funds over the last 2 years. So if you take the Japanese funds away, what you see is a stabilization of the REIT dedicated market share, which is a good thing, and it also is warranted because the big dedicated REIT fund managers have outperformed over the last couple years. We have to keep our eye on the Japanese funds though. They own about 4% of U.S. REITs still, and it's more likely that that figure will go down than up over the next couple years.
Now, 2 years ago, real estate was reclassified as its own headline sector under the Global Industry Classification Standard. Has that been a tailwind for REIT investing?
A couple years ago, when this event materialized, it was thought that it might be, and our FlowTracker research explains why it has proved to be a bit of a yawner. It really hasn't resulted in the needle moving at all. And a key reason for that is just going back to that underlying ownership structure of REITs. The REIT dedicated constituent of investors is so large that they tend to box out the generalist active investors. So REIT dedicated active and passive investors own about half of REITs. That's significantly larger than dedicated ownership of any other sector of the economy. Then you need the generalist passive investors to get their fair share because they're trying to own a market weight position in every single stock. That leaves only about 1/3 of REITs for the generalist active investors to own, which is far below their benchmark. So their ownership is down here, benchmark weighting is up here, and they're just perpetually underweight. They have been historically, they are today, and we expect them to remain significantly underweight going forward.
Any last takeaways?
Sure, just going back to the public and private market pricing discussion from earlier, at some point this will come back in to the long-term average of REITs trading in line with NAV. And that could happen via one of several ways. REIT fund flows could improve and REITs could trade up closer to NAV levels. Private market pricing could decline. In the meantime, one thing that we think that we should see is more REIT privatizations. This cycle has been disappointingly light in terms of REIT privatization activity when you compare it to last cycle. And I would also add that last cycle, activists were not present in the REIT space, and they have facilitated some of the M&A that has occurred this cycle. So to see a period of M&A materialize, you need three things, and we have two of them today. One is a lot of dry powder on the private market side. Dry powder for private market investors is at a record high. Second would be deep NAV discounts, especially in the core sectors. That suggests that it would be in the best interest of REIT shareholders for the REITs to sell to the private market investors. The third part that's not clearly there, only in some cases, is good REIT corporate governance. Once we get all three of those items combined, we should see more M&A in the REIT space.
Dave, thank you so much for joining us.
Thank you very much.
For more from REIT World 2018, be sure to visit NAREIT's website, REIT.com.